if you know me, you know Heather, and if you know Heather, you know me. I'm going to hand it right off to Josh, who's the man of the hour.
Great. Thanks, Andy. So I'm Josh Daly with the SBDC as well. Let me see. So thanks to Andy at Cooperative Extension at URI and also to his partners at UConn and UMass who spread the word about this as well. So if you're joining us from Connecticut or Massachusetts or elsewhere, there are both cooperative extension resources available to you if you haven't taken advantage of those before, and also SBDC. You know, we cover Rhode Island SBDC, but there are SBDCs in every state and territory in the country. So, you know, co-op extension has focus on helping you with your production, technical assistance around helping you there, and the SBDC you know, complements that nicely. We sort of work on the business side of things with you. So this is a little bit about us, the SBDC. I mentioned this last time, so I won't say too much. The bottom line is, you know, we're a resource here for you as small businesses in the state, whether you're have an existing farm or you're getting started. We're here for you. We have a full-time, part-time staff. We do webinars and workshops like this. When times are normal, we do them in person, but these days it's all online. And you can see lots of recordings that we have of other webinars that we've given. And we have a staff that does these, but also does a lot of our work is one-on-one, no cost counseling and assistance to small businesses. So this is really only the start of a conversation, very much a two-way conversation today. So don't hesitate to, as Elena said, pop your questions or comments in the chat as we go. And then also don't hesitate to reach out to us if there's something else we can help you with, or you have other questions you want to dig into. So with that said, we'll jump right in. Whenever I do a multi-part or series of things, I like to start with a quick review. So as Andy mentioned, you know, he sent out and Elena sent out the videos, so you can definitely review those if you haven't already. But just the quick takeaways, we used two tools last time to talk about business planning. Today, we're going to talk about financial planning, budgeting side of things, and we'll use a tool, a one-page tool for that as well. So, and these things go hand in hand, right? So the thing is to make sure that your business plan and your financial plan talk to one another and are integrated. You know, it makes sense. Each of these are kind of one-page tools. They fit well together. We can help you flesh them out as you go, as you have questions, want to improve them. So we talked about last time the business model canvas, a one-page visual tool, talking about that acronym FOCUS, so your financial, operational, customer, and us or team. And it's a good tool for mapping out visually your business operations as they stand and as you want them to be. So it looks something like this, although I've overlaid those three big areas. You know, it's underneath that is the 9 building blocks of the business model canvas. So if you haven't, go back and listen through that first webinar. We sort of broke down each of these things pretty well. So it should give you a good way of framing and thinking about what you're currently doing and what you're planning to do in these different areas of your business, and making sure that you have, you know, good plans in each of these areas to improve your operations, your sales and marketing, and your financial management. So we'll dig into that financial management piece of it more, the financial planning piece of it more today. We also last time used this one-page business plan from Farm Credit East. You know, I said this last time and I stand by it. Life is an open book test, cheat off the smart kids. They've got some good resources. They're a good organization. And so they have this one-page plan, which again, you can take your business model canvas and turn that into, you know, this one-page plan. How's it going to connect? You know, what are your financial goals, operational goals, customer goals, and then how, you know, break that down into, you've probably seen that acronym before, SMART goals, and what actions you're going to take. And having it as a one-page plan allows it to not be a, you know, 50-page thing that sits up on your shelf and you never look at it. If you have your one-page plan and you can put it somewhere in an office, in a room that you're going to see regularly. Where am I? What am I doing? What am I moving forward on? How am I doing on reaching my goals? So this time we'll do a quick framing again of using these tools. And this time we'll really dig into one tool, which is just this one-page budget and financial plan, also adopted from Farm Credit East. I adapted it a bit and added some things to it, but we'll send out that tool and we'll dig into it today. So this will look familiar from last time, just to recap, when you're doing your business and financial planning, again, the point isn't just to write a long document that you never look at again. The point is to, do your homework, know your business, know your industry, know your market, know your customers, do the research that you need to do to make sure that your plans aren't just, wishes and hopes and naive sort of wishings about what the market or industry might be like, but it's rooted in some reality. So you want to make sure that good business planning is rooted in doing that kind of homework. And that's stuff that, if you feel lost on that, that's stuff we can help out with. So don't hesitate to reach out. The other big thing I think about business planning is about getting focus. Remember that acronym, getting focus and guiding action. So that's again why, use these tools as just one-page tools, because it's easier to get focus when you trim down rather than, write a long business plan that you could never, follow up on. And it should be, again, guiding action. If it sits up on a shelf and you never think about it, then, it's not really helping you all that much. But if it's, how am I going to improve and what are my plans and my action steps for improving my finances, improving my operations of my production, improving my sales and marketing efforts, and I know what the core things I'm going to do, that's really going to be a useful tool for you, right? And so that's these notes again about any of these tools that we're using. They're tools, and just like in farming, a tool is only as good as it is useful as it gets the job done, right? And so if it doesn't get the job done, or if it doesn't work exactly, don't hesitate to adapt, let go of what doesn't work for you. And then also, there's some business jargon. I'll do my best always to translate that into, common speech and into concepts that actually are meaningful for you. So no need to use business jargon, except for some of the language you may want to know for when you're talking to a lender or someone else. So here's that tool, the one-page budget. I've broken it down. We're going to send you out the actual one-page budget. I've broken it down into different slides where we'll do this together. So the tool that we'll send you has, I think they break it down as 7 steps. I've condensed that a little bit for the purposes of the slides, just these 5 steps to creating your one-page budget. It sort of presumes that you've been in operation, although you don't have to. So starting with looking at how you did last year, and then we're going to talk about a simplified income statement, and then a budget for the coming year, and getting to what's called break even, and we'll talk about that. And then we'll talk about, again, how does this fit into the planning process? How does this fit into getting focus, guiding action, improving what you're doing, right? So first step, starting with last year's records. So if you are new and you're starting a new farm, we can help with templates. We can help with industry information. We can help with guidance on how to get going on a budget for a new operation. Obviously, it's not as easy to budget for a brand new operation. You can't. It's not as predictable. You don't have prior years to go off of. But we can help you make sure that you're starting someplace relatively reasonable. So, and I think Andy, as we've had conversations, has stressed that this is an important piece, this next bullet point. As you're doing this and looking at last year's records, you may need to take stock of how good your record keeping is, how complete, how detailed, how easily accessible are your financials from the business. How do you keep them? Another thing we can help with, our staff can help with, is improving that as you need to. So
I would suggest that In some way, it's a good idea to keep your record keeping very closely connected to the record keeping of your inputs in your farming operation. Because, from my end of things, I'm always asking people, well, how much nitrogen did you apply? At some point, it's also useful to know how much that nitrogen cost you to apply. So you can look at your bottom line.
That's an excellent point. I think that's true. Obviously for farming businesses in particular, but it's true, outside of the farming industry as well. It's good to tie your financial and non-financial things together. What is it that you're doing in your production and operations, keeping track of that, and important numbers that you need to keep track of regarding your production. Also at the same place, in the same way, connect those, keep track of those with the costs associated with them, or with the the amount that you've produced, all of those types of things that you're keeping notes on. I've seen people do it through Excel spreadsheets. We have some templates of Excel spreadsheets. I've seen people do it through other software tools. I've seen people do it through financial record keeping through QuickBooks or other tools like that. We've helped people with all of those things. If that's overwhelming for you, or if that is something you want to, part of your plan, you want to shore that up, get that tighter, we can help you do that. So we can also help you with thinking about the industry, and looking at industry financial information that might be helpful. And I was supposed to find out what the marketing spend for the industry average was for the percentage of sales that gets spent. One of the tricks I talked to Andy about is that it's different by different types of farming. So what I'll say is I'll send something out in an email that'll give you some numbers on that when we follow up on this. But then if you want to know more about your specific area of farming, or the tools that we have access to, we can get financials for Rhode Island specific. We can get it for a size by revenue, so you can get a sense of how much they're spending on marketing, other financial gross margin, cost of goods sold. We'll talk about those numbers.
I would also add, and I'm only just thinking of this now, Josh and I talk a lot about all this stuff. So, but there is a conference called New England Grows every year. It took place a slightly different time this year because, of course, it was all online. But New England Grows is hugely about marketing, and it spans a very broad aspects of agricultural industry. Could be anything from cut flowers to greenhouse production to value-added food products, to all kinds of things. But in a sense, it's probably something to look into. You might want to look at their website. It's called New England Grows. It's a conference, but they probably have a lot of resource information on marketing on there.
That's great. So moving on to step 2. So it's calculating your 5-line income statement. So an income statement, if you're not as familiar with that, is one of the financial statements that's typical to a business, also called a profit and loss, or P&L. So the 5-line one is just a simplified one. You can add more things to this, but this is a basic sort of record. It's over a period of time, for a year. In this case, you could do it over, a different period of time if that made sense for you. We're going to define all these different terms as we go too. But you've got, these 5 lines are just your sales, the revenue that you've made over the course of the year, your cost of goods or cost of goods sold or cost of sales, that gets our COGS. That all is the same thing, which is, we'll talk about what that means. Sales minus your cost of goods gives you what's called your gross margin, and then minus your overhead expenses gives you your net income, right? So, one important thing in this is to take stock of where you are, and not just how you're doing in terms of gross sales, but how you're doing in terms of your net, how you're doing in terms of your margin for different products. So let's define some of these things. So cost of goods sold is any expense that helps you produce one more unit of output. So it's something that directly goes into creating a unit of what you're going to sell, right? So for farms that you're talking seed, soil, fertilizer, labor, other things that are directly tied to the amount that you're going to produce. And one of the important things is can you in some way break it down per unit? So that's what cost of goods sold means. And then overhead is any expense you incur, any expense you have, regardless of your production level. So if I grow nothing or I grow, whatever amount I grow, I still have these overhead expenses. So that might be, this up here is direct labor, direct farm labor. This is, office salaries, other, wages that aren't directly tied to production, or repairs for your equipment, supplies. This is where your marketing cost comes in. Now, even though your marketing cost is part of your overhead, you can use it to identify how much am I spending on marketing? What's the return on that? How much is it improving my my sales, right? There are other ways of calculating that. Utilities, insurance, interest, taxes, depreciation. The one-page sheet from Farm Credit East talks about the dirty five, which has to do with your depreciation, interest, taxes, repairs, and insurance. So what's not included here, your capital or equipment expenditures are not included on your income statement. They come on a different financial statement, your balance sheet. So let's look. I think we've got a number of questions coming here in the chat. So I'm going to.
No, it's actually a
you.
back and forth about what I mentioned, which someone named Laura corrected me. New England Grows was a different thing, and it's actually now out of business. It's Harvest New England.
Harvest New England. Okay, great.
Sorry about that.
Thank you for that that correction. But as you have questions on this, feel free, comments, questions, throw them in the chat. We'll stop in a second for dealing with your questions. So one of the other things that's a good thing to do when you do this 5-line income statement is to break things down as a percentage of sales. This is in financial lingo, it's called common size financial statements. So, the important thing about this is now if I do this, I can compare year to year, season to season, month to month, whatever it might be. I can compare myself to the industry. I can compare better through the percentages than I can through the raw dollar amounts. Because if a farm made 300,000, I made 200,000, it's harder to, off the top of my head, compare, how they're doing in terms of their cost of sales or overhead relative to that. So that's another step to take in calculating your 5-line income statement.
Hey, Josh.
Yes.
Can you can you go back? Yeah. Just to be clear, I see the word cost of goods is used.
Yes.
Now, when I use the word cost, I think about what I have to shell out.
Yep.
Okay. So in other words, the cost of production.
That's correct. That's really what that is in farming terms. It's the cost of your production. When you're producing an additional unit of tomatoes or whatever it is, what does it take? What are you spending on seeds, on fertilizers and soil amendments, on any number of different things that are going directly into that growing? So that's what cost of goods means. Yep. And it's the cost of those things. It's not the we want to see how productive they are, what you can how you can generate sales from it.
Okay. It's language that confuses my head because I go out to purchase goods.
Yep.
When I move around in the world, I need goods, and so they cost me something.
Yep.
But so that's why we as farmers, we put on a production.
Yep. So think of it, you could think of it as cost of production. You know, the terms you'll hear thrown around are cost of goods sold, cost of sales. You'll hear COGS as an acronym. That's what that means. So this means that, you know, if I sold 200,000, you know, worth of product, I spent 100,000 in all of the, you know, seeds, soil amendment, direct labor, all of those types of things. So it means that for that level of production, it cost me 50%, you know, to generate that, right? My cost of goods is 50%, which means my gross margin is 50%. If I can improve this, right? If I can lower my cost of goods, if I can improve my sales without spending more, get more efficient, then I can improve my gross margin, right? Which generally is going to improve your bottom line as well. So it's a way of thinking about, you know, how can I improve that? Can I be more efficient with my production, other things like that. So one of the things that we talked about last time in the financial side of this was the different revenue streams that you might have in your business model, and thinking about, go back and take some time to think about that in your business model canvas and your business plan. How can you add additional revenue streams? Can you bundle products? Can you have add-on? Can you make more money? You know, value add, you know, can you make more money without having expenses go up at the same time, right? Can I increase my revenue without increasing my cost at the same time? And can I diversify my revenue so that, you know, it's coming in ways that I have cash coming in, you know, regularly. We'll talk about cash flow in a little bit. So this is, if you want to, and if you can, this may be a helpful exercise to break down your sales by the different channels. And this is just one example. There may be different ones. You may decide, if you do a very different product line, you know, from two very different products. I mean, I think last time we talked about, you know, in the growing season, you might sell a set of, you know, vegetable crops, and then in the off season, you might do, you know, snow plowing or, you know, selling of Christmas trees or whatever else. You know, that would be two very different lines of business. This might be where you separate that out and look at your different lines of business. So, and then you also, if you can, again, want to break down what the cost of production for each of those things are. Now, you very likely will not be able to break down the cost of production. You know, you're going to produce tomatoes, let's say, and you're going to sell them to several different places. Here I broke down farmers market, CSA, restaurant, institutional, could be whatever. You're going to sell them to those different places. You didn't have a different cost of goods. They're the same tomatoes. So what you do is you might divide that up evenly if it's an even amount of units that are sold, or you might divide it up by the percentage of the units that you sell. And then this is where you can also see how good your margin is. How an institution, for instance, an institutional. Now, this is not realistic because, you know, no farm that's doing $200,000 in sales is likely doing much in institutional sales. Possible, but institutional sales, they may want a lower price point, right? Higher volume, lower price point. So your margin, your cost of goods sold is going to be higher, and your margin is going to be lower for that market, right? Same product, same costs of production, but you're not able to sell it for as much. So you have a little bit of a lower margin. Now, you may have a trade-off of, I want to sell more volume, and I'm willing to, you know, discount and do that. Or I'm going to sell a smaller volume at a higher margin in certain ways, right? And so there's a balancing there and a planning for your business of where you want to focus your energy. It might also be, if you can break it down this way, and it might take a little bit of work, but if you can break it down this way, you can also start to see are there areas of my business where I'm not making as much money or losing money or, whatever it might be? Why is that? Sometimes, there in business, there's something called a lost leader. It's something where you might lose money on it, but it builds a relationship and gets more sales coming in the door later. But sometimes it's just, inefficiencies, it's just, discounting, it's just, whatever it might be. So this is an important piece of figuring out how well you're doing financially in your business and in the different lines of business that you're doing. So questions and comments so far on any of that? I know that's quite a fair amount of information. We've got one question here from Tom. So Tom says, how do you parse out farm labor between overhead and direct towards cost of goods? On a small farm, workers are often involved in both. Is it usually estimated? So yes, it's sort of a best case what you're able to do. Yeah, generally there's going to be sort of, you're not going to have, it's quite so neat that, it's very clear, farm labor is only doing direct production sort of stuff. So you might estimate how much time they're spending on production versus overhead related things. So that's, yes, usually you make some sort of an estimate based on what you know about the production versus overhead and other business activities.
I would still say though, I think it would lean more towards direct cost.
Treating all of it as a direct cost for the most part. If they are, I would separate out anyone who's doing, office related work, marketing related work, sales related work. But yeah, I think there's also a case to be made that, anyone who's doing farm labor, you could create that as a direct cost and think of that as a, cost of goods. Other questions that you have so far? It's a good question. It's an art and a science, all of this, it's not, there's, and there are tools for you to use to manage your business, right? So I'll keep going, but keep the questions or comments coming, and we'll keep the dialogue going. So next piece, we're moving from your last year's income statement, 5-line income statement. I jumped, and we might have another question here. Okay, so when you say institutional, do you mean wholesale? So that's a good question. So when I say institutional, you can slice and dice this however it's useful for you. So use the terminology that's useful for your business. So when I say institutional, I'm thinking, someone who's selling to schools, hospitals, institutions in that sense. But you might separate it out. It might be more meaningful for you to separate it out as wholesale. So now I'm selling wholesale to retail markets or to restaurants or to wherever else. So it usually is wholesale when you're selling institutional. Well, it's not exactly wholesale. I mean, it's a different type of market. But
I would say it also, it depends a little bit on scale.
right.
Usually institutional sales are, you're dealing in many cases of product.
That's right.
You may be selling wholesale to a small retail store or a restaurant, but you might be selling one case of this, one case of that.
That's a good point. Yeah. Yeah. So that's again, any of these labels, any of these tools, tweak them to work and fit best for your business. So yeah, institutional, I use that term. Wholesale has more to do with, am I selling it at a discount and then they're going to go turn around and sell it at retail, whether that's going to be retail, in a retail store, whatever it might be. So yeah, use what's useful for you. Great question. So I'll keep moving, but keep the questions coming. We'll take them as they come. So moving on from the one-page financials, the one-page income statement, profit and loss statement, to now planning your budget for the coming year. So Farm Credit East, and I use the same approach, so I like it, does a bottom-up budget. And so what that means is, these are sort of reversed from what you saw on the 5-line income statement, right? So desired owner's draw, how much do you want to make over the year? How much are you targeting to try to make for yourself as the owner? Include your income tax on that. That's effectively going to be the net income that you're shooting for, right? Now this adds in bank principal payments. It's really any other expense after net income that you're going to have to pay. So bank principal payments, anything else that you'd have to pay after your net income. So we're going to put some numbers in here in a minute and show how this sort of fits together. But I say, okay, I want to make, X amount of dollars, including my income tax. I know I'm going to be taxed at this, or I anticipate I'm going to be taxed at this level, income tax. I have this much I'm paying on a bank loan in principal, not in interest. Interest would be calculated in your overhead. And then if you add A and B together, these first two lines, you get your required net income for your budget. And then you add to that your overhead. And when you add those two things together, you get your required gross margin, how much I have to make after my cost of sales, right? And then I divide that number by my percentage for my gross margin, and that gives me my required sales volume. So what's called your break even. So I'm going to put numbers in there, and it should hopefully make it a little less abstract. So let's say you want to make $100,000 in the year, and you want so you have to include income tax. So after tax, maybe you take home 75, whatever you take home of that, right? What do you want? What do you need? What do you want to shoot for? What's realistic? Then let's say you have to make $20,000 worth of principal payments on a bank loan that you have on bank loans that you have on equipment or whatever else you've got, right? So what's due in principal payments for the coming year? So I add those two things together. That gets me to, I have to get to make this much, I need to get 120,000 in net income. Then if I had 80,000 in overhead, this is taking from that last year's overhead, right? From the 5-line income statement. So generally overhead's going to stay the same for the most part. Unless there's some significant expansion or change in your operations, right? So generally overhead, you're trying to manage it in such a way that it tends to stay the same. Cost of sales tends to go up with the amount that you produce, right? It takes more seed and fertilizer and whatever else to produce more, right? Generally, unless you get more efficient. So cost of sales will go up with sales. That's why it's pegged as a percentage usually, right? Overhead is going to generally stay the same. So if I can cover my overhead and my cost of sales, that's what you call that break even amount, where now if I hit my break even, if I cover my cost of sales and my overhead, what I make after that is more profitable. More of that becomes net income. Let me stop and make sure that that makes sense for everybody. Is overhead and cost of sales another way of saying fixed and marginal costs? More or less, it's not exactly the same thing in accounting, but it is, they are relatively interchangeable. So yes, fixed costs tend to be overhead costs, marginal costs, unit costs, cost of sales. That tends to be that, yes. So if you're familiar with fixed and marginal costs, It's not exactly the same, but it's there's certain nuances, but yeah, it works.
I have a little question too, Josh.
Yeah.
You said you have bank principal payments.
Yes.
Is that referring to the fact that the interest has been parsed out of that?
That's correct, because the interest is included in the overhead. So there are certain expenses that don't show up on your income statement, that don't show up on so one of those is principal payments to the bank. So that's why that's there. So going through this, so now we've got a place where if we add in that overhead and we say it's going to stay the same, then now we need to get 200,000 as a gross margin, and we had 50% gross margin. So it went on our 5-line income statement from last year, right? We had 50% cost of sales and we had 50% gross margin. So it means that at this level, we need to get to 400,000 in sales. So I divide 200,000 divided by 50%, right? Remember, when you divide by a percentage, it's like multiplying. So it's dividing by 50 is like multiplying by 2. So I need to get to $400,000 if I want to make this much. That's my break-even level. Questions, comments, confusions about that?
Yes, someone is.
I'm confused. How do you get the percentage for line F? That's from your historical gross margin. So when we go back to that 5-line, I'm going to go up to it. You see this here? So that's your gross margin right here, and that's your percentage. So you get it through your historical. Because generally, you're going to keep a similar margin unless you can improve that margin, right? But you're going to plan generally around the margin that you've made. And that's the overall margin. So we notice that, you know, there may be different margins by different channels that you're selling into, but your overall margin is 50%, right? Another question, it looks like. Got it, thanks, great. Okay, and so I also want to, you know, point this out to you again, that break even, which is what this $400,000 is, it's break even. It means that I will, if I make $400,000, I will get it's better than what you might call break even because you're paying yourself, but you should build that into your break even, being able to pay yourself what you want to be able to pay yourself. And then anything after this level is going to be more profitable for you because it's going to drive more to your net income, right? Because you've already covered your overhead generally, right? So if you can improve your production and cover your fixed costs, then, you know, anything above 400,000 in sales in this example is going to drive more to your net income. So that's a way of thinking about, you know, improving your efficiency, improving your profitability.
A lot of farmers don't pay themselves.
That's a fair point. A lot of small business owners don't pay themselves.
Yeah.
And so how can you, you know, one of the things for your planning is to think, you know, what does it take for me to get to a place where I can pay myself what I want or need to pay myself, right? So if I don't pay myself what I want or need to pay myself right now, how can I pay attention to those costs that we broke down, those costs of sales, unit costs, or overhead costs? Or is it that I'm not getting to a level of production and a level of sales that's going to allow me, have I not gotten to that break-even point where I can cover all of my costs and pay myself, right? It may be that I have to ramp up my marketing to you know, increase my sales and ramp up my production at the same time to increase my sales. So other questions or comments on the budget so far?
You feel free to unmute yourself and pipe up if you like.
Absolutely.
I have a question. In the budget, as far as paying yourself, I know a lot of times from the small business side, either it is smart to pay yourself, but from my experience in the not-for-profit side, they don't really want to see administrative costs in the budget. So I do have a question about that. Would you be creating this kind of budget for like the Farm Credit Agency? And if so, what do they consider a reasonable cost for a farmer to pay themselves?
Yep, that's good questions. So first of all, and certainly different for nonprofits than for-profits. I know there's a big, sort of policing of overhead expenses in nonprofits, and I think I'll leave that as a separate conversation. But if you went to a lender like Farm Credit East or whomever else, that may be where industry averages come in again. They may want to see you not paying yourself, way above an industry average, but really, I think a good lender wants to know, how are you going to make a living doing what you're doing, and how do we support you, getting to a place where you can pay yourself what you need to pay yourself. So we can use industry numbers to get at what a salary might be. For the IRS purposes, generally they want to see that owners take some sort of salary that's reasonable, and not just take it through what's called an owner's draw. So you pay payroll tax on what you take as a salary, depending on how you have it set up. Did that answer your question? I think I got most of it, but it's basically industry and then making sure that it seems reasonable to you, that you can live off of it.
Okay, yes.
Okay, great. Good question. Any other questions or comments so far on the income statement or the budget? Okay, so keep them coming, as I said. So and as Andy said, we're a relatively small group. You can unmute yourself and pipe up if you want to make a question or a comment. But we'll keep moving in the interest of time. And so now you've done sort of the work of creating this budget. Doing that last year's 5-line income statement. That may take some work to get your your records together, to get your financials in order. As you do it, comparing year to year, comparing you to the industry, those are helpful things to do as you manage the business. So now you've done that, and you've done the budget. Some time associated with each of those things, but hopefully not overwhelming amount of time. And again, we can help you do that. And again, we'll help you get, sort of good control over what it is that you're doing, and good reins over your business, and feel like you can make some plans that help you improve your business. So now this, what I call step 5, I think on the 1-page thing that we'll send you, it's the last step. Take a step back and review. Basically now we're trying to think about, does this make sense? So now I've looked at my historicals. I've created a budget based on, what I want to make. Does it make sense? Can I, what we just did was, I want to make $100,000. This is the hypothetical and made up situation, but I want to make, whatever I want to make. And in order to do that, based on my budget, from the bottom up, I need to make X dollars in sales. Can I make X dollars in sales? Does that sales volume seem reasonable? Based on the market, based on what I've done, based on my production, can I grow or raise enough on the acreage that I have? Can I get the same prices that I get, the same margins that I get if I increase the scale? Sometimes to sell more, as you might sell wholesale, you might sell, whatever else, you might have to discount your prices to get into certain markets. So you want to ask these questions of yourself and of your budget. What do you need? So I did a 5-line income statement that was $200,000 in overall sales, and then I did a budget that was twice that much for the next year. And I said that the overhead would stay the same. Now, in reality, if you're going to double your sales, your overhead is not likely to stay the same. Hopefully you can control it. It doesn't go up, the same amount, but generally it's going to go up if your sales go up. So is that reasonable? If you need to expand or change your operations significantly to increase your sales, what does that cost? What's the cost of that expansion? Any equipment that you need, whatever else you need, any additional space you need to lease or buy. What's your financing plan for that? What's the timeline for that? And on both sides, whether you're going to expand your operations or continue at the same level of operations, you want to then take that and develop a marketing and action plan to reach the sales level that you desire, right? So I'm going to try and reach that level. How am I going to do it? Who am I going to sell to? Which customers? How many customers? How much are they going to buy? Can I improve the amount that I'm selling to a particular customer? We talked last time, marketing activity isn't just about getting more and more people or customers to buy from you, but also selling more, adding more value with the current customers that you've got. So that next step is ask those questions, give it the kind of reasonable test. Does this budget make sense? Can I work with this? And then what's it going to take as a plan to get me there, to sell what I need to sell? So I'm going to dive in also a little bit here, but just a snapshot of this. These are good tools. They're not the entirety of your financials. And there are other financial tools that you can use. Again, I'll keep this refrain going. We can help you with all these things. So don't feel like you have to jump in the deep end and be overwhelmed in this. Reach out if you have questions or concerns or comments, or just want to get feedback or see you're doing it the right way. There's the income statement and a projected budget or projected income statement. And then there are other financial statements and other financial tools. So the other big ones are what's called a cash flow statement and cash flow in general as a concept, a balance sheet, and financial ratios. So I'm going to take a minute just to talk about what those things mean, and try and break it down in a way that's understandable. Again, if you have questions on this, this is not second nature. This is not something people just grow up knowing, or by osmosis. You have to learn this stuff. So there's no shame in not knowing it, and ask questions. I think I've said this last time too. Business jargon, if it's jargon for jargon's sake, it's BS. It's not worth your time. If it's jargon because it's a concept that is helpful, take time to learn what's helpful about it, and translate it into your own terms. So cash flow has to do with that timing of cash coming in and going out. The flow of cash in and out of your business is as important as the dollar amounts that you're making, right? So some customers pay you faster. That's better, right? That you want to have a mix of probably folks who are going to pay you at different speeds. You want to make sure that you have enough cash coming in. The quicker they pay you. Walmart's model is entirely based on being a cash generator. They don't pay their suppliers until the moment the product sells off their shelves. So they have not put any cash out. Now it's not entirely they haven't put any cash out, but generally they haven't put cash out when that product is on their shelves. And then when it sells, they put that cash out and they get the cash in. So that's a very quick cash cycle, right? The longer your cash cycle is, the longer it takes for you to put cash in and get cash out, the more you're going to be vulnerable to not having the cash you need, right? So cash is king. What's not just how much you're going to make, but when is it going to come in, right? How often is it going to come in? How quickly? Can you think about different payment scenarios? A CSA, community supported agriculture, is effectively a marketing and financial arrangement, that is beneficial has benefits for both sides, your customers and you, but in particular for you, it has that benefit of having money come in the door at the beginning of the season, right? And then I have to outlay money, finance, my growing season. And then I know I've got people who want the product at the end. So it helps me plan and it helps me manage my cash flow. If I have to put all that money in up front and not know on the other end if I'm going to sell it, it's a little more risky in terms of the cash, right? That's going to come in. So we talked last time about different business models, and those different business models and what you choose in terms of your revenue streams, subscriptions, CSA, bundles, value add products, partnerships, whatever it might be, contract farming, those things have implications for your cash flow, when the money comes in and when it goes out. And just, a big portion of this is managing your business is also managing your cash flow, and how well you manage that. Because if you run out of cash, now I got to figure out where it's going to come from, right? And now I've got to go to maybe a lender, and that's a difficult place to go to a lender, because now you're in a tough spot, and that's often the conversations you don't want to have with a lender. Although I will say, Farm Credit East, FSA, I think know, working with farmers and know that happens. So, but that said, you want to plan. That's cash flow. Balance sheet. Balance sheet is a point in time snapshot. It's only accurate for the moment that you give that snapshot. So it might be the end of the year, but that balance sheet is only good for that end of the year. It only represents that point in time of your financial position, how well your company is doing, based on there's an equation for the balance sheet. Assets, what you own. So your cash, your receivables, if somebody owes you money, that's an asset. Your inventory, your equipment, your land if you own it, your whatever else, those are all assets. What you own is equal to your liabilities, what you owe. So if you have payables that you owe, if you have loans that you owe, whatever it is that you owe, it's equal to your liabilities plus your equity. So what this means is the value of your ownership, your equity, is your assets minus your liabilities. So if you can generate more assets, then you're increasing the value of your business. If you then went around and either went to sell it or went to get financing or whatever else, those are going to be important financial metrics for a buyer or a lender to look at, to see that you are doing well financially. Certain things show up on your balance sheet that don't show up on an income statement. So the value of your land, the value of your equipment. Someone asked about that last time. Where does that show up? It doesn't show up on your income statement. It shows up on your balance sheet. Now, you can look at how efficient and how productive that is. There are measures, and that goes into ratios. So ratios, remember your math from grade school, ratios are just comparing two numbers, right? Comparing two numbers to one another. So there's 4 different types of financial ratios. One is profitability. What's your profit margin, right? What's called your return on equity or your return on assets. So that means how profitable am I based on the equity, the investments that I make? How much do I get back out of that? The assets, how productive am I being with my assets? That's what that measure is. I don't want to get too deep into the weeds with this. We can help you with, looking at these and interpreting these to see how well you're doing. Solvency has to do with how well you can cover your debt. There's a debt to equity ratio. Efficiency has to do with how well you use your assets and equity to make money. It's the turnover. How quickly do you turn over things? Your liquidity looks like what your cash is. What's your cash position? How much cash do you have relative to what you owe, right? So that's your liquidity. When are you going to run out of cash? Doesn't value of the land and equipment show up on income statement in the form of mortgage/rent and depreciation on equipment and that sort of thing? So that's true. it's the value of the land and the equipment doesn't necessarily show up in the form of mortgage or rent. Mortgage or rent payments, again, you'll get the interest payments on your income statement, and you'll get the principal payments on a cash flow statement. And then depreciation on equipment, yes, is a way of sort of keeping track of the usable life of an asset, right? So depreciation is, and from a tax perspective, there's tax write-offs from a tax perspective, I want to minimize my taxable income. So I want, to make as much net income as I can from a financial perspective, but from a tax perspective, I want to have, as many things on there like depreciation that can reduce my my net income, so I don't pay tax on it, right? So depreciation is not a cash expense. You don't pay anyone. It's really an accounting procedure to, if you're doing it right, you're probably squirreling that away so that when you then have to go and buy new equipment, you have, money for that, but it's not necessarily how you have to run things. So good question. Other questions about this? I know this part of it gets into the stuff that might make your head spin or your eyes, go into the back of your head or whatever. So if that's the case, feel free to, reach out if you want to sort of talk about what this means for your business specifically. So I wanted to take that step to just talk about those things because it is another piece of the puzzle when you're thinking about your financials. It's sort of additional. You can still do your, 5-line income statement and your 1-page budget without necessarily doing all of these other things. But this can be another way of looking at how well you're performing financially and improving how well you're performing financially. Usually,
Josh,
yeah.
does SBDC help people one-on-one with coming up with these sorts of ratios or taking their temperatures on their businesses?
Yes, we do. So we'll help you. We can help you put together financial statements like this. We can help you put together everything that we've talked about so far. We can help you put those things together. We can help you analyze those things and make, judgments and decisions about your business based on that. We can help you look at it relative to the industry. Again, all those things are in the wheelhouse of what our staff do regularly. And it's all free and confidential. And we have a full-time and part-time staff who are dedicated to that. So don't hesitate to reach out.
I did just put in the chat the link to register for one-on-one counseling.
Great. So and then Diego asked if those services are only for Rhode Island businesses. So I'm with the, Elena and I are with the Rhode Island SBDC, Small Business Development Center, which is headquartered at URI. There are SBDCs, Small Business Development Centers, in every state and territory in the country. So there's a Massachusetts SBDC, Connecticut, name all the 50 states, and all the territories. There's an SBDC where you are, wherever you happen to be watching this from. So you can look up, you can Google, Massachusetts SBDC, Connecticut SBDC, whatever else, you'll find them. So, and they are all set up generally the same way. They're all going to be, they have different setups in terms of the, they're at a different university. They might run slightly differently, but for the general way, they're going to do the same types of services. So they can help you with all of these types of things as well. And they're also, designated to be no cost and confidential, because it's all connected to that national SBA network. The Small Business Administration puts money in, the state and the universities put money in, covers all the costs, and then it allows us to do what we do for you for free. So if you're elsewhere, if you're in Rhode Island, reach out to us. If you're not in Rhode Island, you can reach out to us and we can connect you to, the right people in the state that you're in. But you can also reach out directly to them. Great. Keep questions coming.
Josh, I don't know if this is a question for you or for Andy, and maybe both of you could answer, but so my interest in this meeting came from the fact that I'm working on a loan with Farm Credit East at the moment for a new farm.
Mhm.
And I'm having trouble finding some of these pieces of information just because I haven't started the business yet. And I can look and, that you can do a certain amount of research, but a lot of the research that you do I don't feel like really applies to somebody in our situation. I need a lot of the information is coming from bigger, more industrial sort of farms from out west that I don't really think really applies to what I'm going to be doing. So I don't know if it's you or if it's Andy or maybe a combination of you guys, but how would I go about finding some of this information that I'm after, I guess is my question.
Yep. So you can definitely reach out to us on the, so the industry sort of financial information that's out there varies, but we have access to databases that we pay for that can slice and dice that to use a farm pun, slice and dice that however you want. So we can look and go more specifically into your type of farming. We can go into smaller farms so that you're not comparing yourself to, like you said, big agribusiness farms, out west or whatever else. Yeah, so we can help you with that kind of thing. I'm sure, Andy, I'll let you speak to, what you might be able to offer in that regard, thinking about.
Actually, I'm just wondering, are you being asked for like reasonable estimates of things?
Yeah, I mean, we're just trying to come up with all of these different documents that you guys are talking about here, and I'm kind of partway through a lot of them. But it's difficult for me to estimate, the operating costs or cost of goods on anything because I haven't begun the farm. So how do I produce a legitimate number for expenses and all of these different types of numbers? And obviously without actually beginning this venture and getting into it, then we'll actually have real data. But before this, I'm finding it really difficult to find any useful information that could actually guide us in the right direction.
Are you going to be doing something, and you don't have to discuss it here, are you going to be doing something that is like absolutely way out, unique and different from anything anyone is doing? And yeah, okay.
I don't think so.
So
I think the info exists. I just have no clue where to look for it.
Well, so I'm just wondering if maybe the info might possibly come from other people who are doing it, as long as you're not, elbowing right into their market.
Right.
There might be certain people who'd be willing to share a little bit of personal business information and give you some ballpark kind of numbers or percentages that you might.
Okay. Yeah, that's I think all they're really expecting. I don't think they're expecting me to actually come up with a legitimate sales and expenses sheet here because obviously we don't know. So, so
why you and I can talk.
Okay, great. Thanks, Andy.
And likewise, and Brenda made a comment that, she's in the same boat, starting something new. So likewise, you can reach out to both of us. Andy's a great resource and we're a complimentary resource for you. So typically what I find is we work with lenders a lot and work with small businesses who are working with lenders. And typically what's sort of crucial in the financials that you present to a lender is the assumptions that you make behind it. So you're going to, do all of these things, and then you're going to try and make some sort of reasonable assumption. And then usually that reasonable assumption is, and the way that we do it is, we try and get some of that data that you're talking about through the tools that we have, through whatever else that we have, and use that as a means of making some reasonable assumptions about what you're going to do. It's an assumption, it's new. You don't have the historical data. The lender knows that, that. But you're trying to, it should tie into also to the business plan. Is it reasonable? Is it within the realm of am I in the ballpark or am I way out of, left field? So a lender is going to look at those industry numbers and compare you to those industry numbers. And if you're way out of whack with those industry numbers, they're going to say, wait a second, what's going on here? This doesn't seem reasonable based on that. So it's that kind of a thing, and we can definitely help you with it as well. So great, yes. So Brenda, we're here for you as well on that. So key takeaways from these tools, the one-page budget and financial plan: the better, more accurate and detailed your financial records, the easier it will be creating your budget and financial plan. Probably obvious, but also like worth putting some work in, if to tighten that up. Again, we can help you with that. What actions this might go into your one-page plan? Do I need to improve my record keeping? How am I going to do that? How do I break that down into even just the simple things like Andy said? Am I keeping track of the right things in the right places? And are they, in a place together where I can pull them up when I need them? That's sometimes, the extent of it, right? It's making sure I have a habit, a routine of keeping track of those things in a place where I can get them readily at hand.
And if not, you may have to do a horrible next winter exercise of trying to trace back and estimate everything you possibly can.
Yeah, exactly. Which is not the position. So be the one who's going to thank yourself at the end of the season for what you did right now. To set yourself up. And I've seen people do it a lot of different ways. Keep receipts, keep records, keep emails, invoices, whatever you got, in some place that they're easily accessible. You can come back to them and work with them later, but you just want to make sure that they're all there. So check your plan, and especially your assumptions, as we talked about. We all know what you do when you assume. Check your plan and your assumptions with trusted advisors. You might check it with lenders. You might check it with Andy. You might check it with me, or someone like us, a co-op extension in another state, or an SBDC in another state. Are you being realistic? Are you being overly optimistic? Andy's talked about, I don't know if you want to say the new farmer honeymoon sort of scenario that you talked about.
Yeah, yes, that new farmer honeymoon is, for one thing, a lot of people, they'll turn over some ground that hasn't been turned over in a long time. There's lots of organic matter and nutrients locked up in that organic matter. And in the first season and a half, you get a tremendous flush of residual nutrients. And it seems like you can't do anything wrong. Furthermore, it may be in an area that hasn't been farmed in a long time, so the typical insect pests and diseases haven't really built up yet. So you just, you can't do anything wrong the first year, maybe even into the second year. And then by the third and fourth year, things are starting to go south and you're wondering what you're doing wrong. And it's not so, and I would, from my perspective, I'd say, well, you got to keep building your organic matter. Don't lose that. Don't burn it all up. But I'm sure there's a good analog for that in the business realm.
Yeah, I'm trying to think of the analog. I mean, that's great. I think there's an analogy for, not expending all your capital maybe all at once, and just, I think the point again is to make sure that you're being realistic. Are you accounting for all costs? Are you, being overly optimistic about your production or your marketing efforts? The third piece here, the third bullet, is connecting these tools that we've used. So the business model canvas and the business model choices that you make of which markets you're selling into, which customers, how you're reaching them, what your value proposition is. What is it that I'm going to do that's going to be different from the competition, that's going to make me stand out, that's going to be relevant and matter to the customer, that's going to offer some specific benefits. We talked last time, it's as simple sometimes as the way you package or deliver your product. It's not just the quality of the product itself, but it might be the packaging, the delivery, the quantity, the selection, all of those things, right? What are the choices that I'm going to make in terms of what market I'm going to go after, how I'm going to go after them, what partnerships I'm going to engage in, what revenue streams I'm going to look to try and build up. How does that strategy connect to the SMART goals that I'm going to set in each of those areas and to the financials? Like that's for yourself and for a lender, if you have those connections, and I can see there's reasonable assumptions that you've made and there's connections. I'm going to do this. I'm going to spend this much on marketing. I've got a marketing plan. That because of that, I anticipate that I can grow my sales. Generally, Andy and I have talked about this as well. Small farming of the sort that I think most of you are in or are getting into is, and I see you there, Rebecca, I'll get to you in a second. So small farming of the sort that you all are in or getting into is trying to carve out a niche in a space where agribusiness in this country has hugely, competing and driving forces around commodity crops, right? And it's reduce the cost of land, labor, equipment, get to these economies of scale and scope where you can produce, and drive cheap food. And that's the vast majority of the food systems in our country. And so for you to likely go in a different direction means you're never going to outcompete them in production. That's just not where you're going to win. So where you're going to win is a better marketing plan, a better story, a better, differentiated niche piece of what you do, better,
Better service,
better quality service, better responsiveness. You stand behind your product. There's a story there. Better financial models. You have good partnerships. You have good a CSA model that works. You have a subscription model that works well. You have bundles and add-ons. You have other products that you add that add value. You have value added things that you make with your products. All those things are going to be the things that usually you're going to create this additional value. You're going to differentiate yourself. You're going to niche sort of what you're doing. And that's likely the game that you're going to want to win at, because the other game, you always want to improve your production, of course, but you're never going to compete on the commodity market with the even just the price of land in Rhode Island. It's not possible. It's not possible to be as efficient as these much larger agribusiness farms. Andy, you were going to say something?
Oh, no, I was not. Go ahead.
Okay. So that's what I would say are the kind of key takeaways. Oh, Rebecca, I don't want to lose you in this. You've had your hand up. Tell us what your thoughts or questions are. You can unmute yourself.
Yes. Oh, sorry about that. Actually, that was a perfect way to end and start my question. When I was looking for land, which I thought would be my first step, now I'm saying it wasn't supposed to be, but I was looking for land first. And I did speak with the farm servicing agency, and they said I would need 3 years of the Schedule F to access their funds, I believe. And so I was curious, is that similar with this farm credit agency, or would this be something that beginner farmers, like really beginner farmers, can access if they have a solid plan?
Good question. So generally, many lenders, and this is true in the small business space, and it tends to also be true in the farm space as well. Many lenders are hesitant to lend, especially large amounts, to pure startup businesses. So it can be harder to get a loan as you're just starting out. That said, it's not impossible. It can be done. I have seen it done. It's when you go to a lender, they're going to look at what they call the 5 C's, or I call them the 5 C's. Some people say 3 or 8. They amount to the same thing. They're going to look at your credit score and your credit history. That's one C together. Credit score, right? Credit score, credit history. Your cash flow, and so you don't have historical cash flows as a new business, and so that's a big sort of knock against you in going to most lenders, right? Then they're going to look at your collateral and the collateral is the value of the land itself, the value of any equipment, of any buildings, of anything, any assets that you've got, and also any cash that you're going to put into the business. And generally, on startup loans, now there are USDA loans that require less down, but startup loans, oftentimes lenders want to see you have a decent amount of cash to bring to the table, because startup businesses in particular, startup farms, are cash hungry, and so having a good amount of cash to get started is a good plan. So and then they're going to look at your conditions. So it's the industry sort of stuff. It's why Farm Credit East and why FSA exists, because farm lending, they have specific expertise, and other lenders, may not venture into farm lending, agricultural lending in the same way, or be as well set up for that. That's the fourth C if you're counting along. And then the fifth C is character. So it has to do with the strength of that business plan, the strength of your resume, the strength of the business plan. Those are the 5 C's. I'll send something out as well when we send out the stuff that breaks those down. That's what a lender is going to tend to look at. They tend to not be as eager to lend in pure startup space, but that's not always the case. And if you have a really strong plan and those other things are in your favor that we talked about, you can be in a position where you may be able to buy the land right from the beginning. There's also a number of other types of arrangements. I don't know, Andy, if you want to talk about some of the different ways that people sort of come about, land, there's partnerships and agricultural easements and, land trusts and a whole variety of different ways that people get land to work.
Yeah, and I mean, I think you said pretty much most of those arrangements. Yeah, it's probably makes sense to find some kind of rental lease situation where you might even just say, okay, I'm going to try to farm for 3 years on a limited amount of land that you don't own, but that you've worked out an agreement with somebody. Those agreements aren't always so easy to work out, because and I don't know specifically what you do or what you want to do, Rebecca, but typically such small farm startup type situations require that someone is on the land doing work all the time. Some landowners don't want that. Some landowners might say, well, you can come in for a week and a half and plant your corn in June, and then you can come back at the end of September and you can harvest it, and we won't hear or see you anytime in between or after. Or somebody who cuts hay, 2 or 3 cuts a season, they're in for 2 days during the cut, 3 days, and then they're nowhere to be seen again. Typical small scale operator of the sort, most of you who are probably watching this, you're going to work every day and you're working 75, 80 or more hours a week. You're there all the time. You need water. You might need a small structure, even if it's an impermanent structure, and somebody may not like that. But there are also some very sympathetic landowners out there who, want to help in this kind of thing. I don't know what state you're in, Rebecca. In Rhode Island, our Rhode Island Department of Environmental Management has a division of agriculture. And there is a lot of support for helping people find land to farm on. I'm pretty sure that's the case in Massachusetts as well. Connecticut, I'm not quite as familiar with.
Hey, Josh, I don't know if you mind if I just jump in with one comment for Rebecca, but I feel like I'm probably in a similar situation to maybe that she's in. And I have a little bit of experience now at this moment with working with kind of the two people she's talking about here, I originally did go to FSA for a loan, and I kind of met a lot of the same issues, and I don't want to say resistance, but it's just their process. You know, they're a federal agency and they have to abide by their rules. But one of the biggest incoming problems for somebody in my position, and possibly hers as well, was the fact that FSA doesn't want to look at off-farm income as a way to pay for your loan, which is insane, in my opinion. I don't know if there's anybody from FSA on this phone call, and I'm shooting myself in the foot here, but you know, so if you're having these issues, Rebecca, I would encourage you to reach out to Farm Credit East. I found them very easy to work with. I found that they're much more, you know, they're much more willing to look at other, you know, potential ways of paying for a loan, aside from the fact that it's just going to all come from the farm. Because obviously, from, you know, us people who are trying to start out, that's not the reality of the situation. So anyway, that's my that's my 2 cents. Not that FSA isn't great for other things, and that they probably aren't great down the road, but I met exactly the same difficulties, and so that's why I've kind of ended up settling with it with Farm Credit.
Okay, thank you.
Yeah, I think that's, you know, get a bit of realism about the, you know, the process, and you know, if you are, for folks who are also, you know, here or listening in later, you know, if you're moving towards wanting to purchase land or equipment in the future, maybe you're, you know, leasing land right now, you know, really what a lender is looking for is a lot of times that historical performance. And so you're in a better position where you can show 2 or 3 years of cash flow. You can show, you know, the cash that you've generated from your operations would cover the debt payments. That's really one of the big things that lenders tend to look at. Yeah, so FSA has its limitations. It's set up well for certain things and not for other things. It's kind of like the SBA, which does, you know, loan guarantee programs, and, you know, the SBA can't look at non-business income when they look at your cash flow either, right? Which is, again, doesn't fit with a lot of businesses, but it's just how they're set up by statute. So it's the limitations of, you know, in other ways they can do things that other lenders could never do because they've got the backing of the federal government. So so it's finding the right fit for you. And we've worked with, you know, each of these lenders and many more, and can help you navigate that process. You know, prepare any of those financial statements that you need to get that industry information, whatever it is. So, and thank you so much for the questions and for the input there.
Matt, thank you. That was good.
Yeah, I really appreciate that, Matt. Remember, this is sort of coming back to the beginnings, you know, about what business planning is about, connecting all those dots, you know, doing your homework, you know, business planning and financial planning, getting focus, guiding your action, and using these tools. Again, I think I've seen 50-page business plans that someone paid someone to put together, and they're not worth the paper that they're printed on because they aren't realistic and focused and action-oriented for the business. They don't actually fit what the business is trying to do. I have seen that to some extent for farm businesses, but a lot in other businesses. So I've seen these shiny, you know, 50-page business plans that you could drive a Mack truck through the holes that are in the business plan. And then I've seen, you know, business plans that are more like this, few pages that break out, you know, some key important information and key assumptions and action items for your plan, and are much stronger because I can see the connections between all of it. I can see, you know, the research that you've done, and I can see, you know, the reasonable assumptions that you've made. You know, that can be a stronger plan. And in particular, it's a stronger plan for you if you're going to use it to operate your business. If I'm going to use it to operate a business, I want it on one page on my wall that I can look back at with some regularity. I don't want the 50-page thing I have to go get off the shelf. It's not helpful as a tool. So we added in some more time and we've used up a lot of it. But questions or comments on anything else? Anything we've talked about today or last time? Any other questions folks have? And again, feel free, you can,